Hello ladies and gentlemen, and welcome back. In today's video, we discuss two topics that everybody's asking us right now. The first one has to be CPI. Realistically, everybody wants to know what's going to happen with the inflation number. We've got some amazing charts to share with you today that may give you a bit of an insight into what's going to happen over the coming months for inflation. The other one is expectations for 2023. There's so many people making predictions about what's going to occur next, and one of those is what's happening with emerging markets. So many people discussing whether this is the place to be in 2023. We've got some really great stats that I think each and every one of you will enjoy. So let's take a look at them all right now. Well, welcome back everyone to the Daily Show. We're talking about stocks, commodities, and of course cryptos today, as we always do. Subscribe if you enjoy that type of content, and of course smash the like button if you find value in our daily videos. We'll be talking about the news indicators, the lead information that's coming out right now, and of course the key levels that you should be watching. Speaking of key levels, you need to know about this bit of news. CPI will be released on Thursday at 8:30 a.m. New York time, and it's going to be a very volatile event. Options are already pricing in large moves, and we'll talk more about that later on today's video. But let's discuss dumb money versus smart money inflow coming into this inflation number. Basically, we've seen a bit of a switch. Smart money inflow has declined slightly in recent trade days in comparison to dumb money, which is on the increase. So we have to expect a spiking of price over the next couple of sessions. When that occurs, we need to be ready at key levels. And remember, it's all about being reactionary. We don't necessarily want to predict everything. We want to see levels being hit and, of course, the market reacting off those zones, which gives us edge in these types of markets. Let's talk about inflation to start today, then we'll go into the emerging markets story and then of course the key charts. But inflation today versus the 1970s. Everyone's been talking about this particular chart. The good news is for the inflation people out there is that we're probably coming down. Now the reason why is because whenever we've seen declines that have been multi-month, we usually continue that trajectory. Just remember though, the Federal Reserve wants it to be down here between 2 to 3%. It's going to take a little while to get down to that. And as we know, the Fed has also come out and stated many times now that in 2023, they don't want to do any rate cuts. They're going to have to rate cut to support the economy, which is starting to suffer. But they've said right now, they're not going to do it. The market's calling their bluff and saying by Q4, it expects rate cuts. And we'll look at that on the charts later on. But basically, this seems to be the trajectory that most people are expecting. Now, why is that? Well, here's some overlays that I think are quite helpful. Basically, here we have fertilizer being overlaid with food and beverage inflation. And you can see they've got a pretty close correlation with each other. What's happened in recent months is we've seen an incredible decline in fertilizer costs. And this actually has started to go up a little bit at the time of this recording because, of course, China is reopening here. And some of the stocks are looking pretty decent on the charts, but this is one of the stories at the moment. Of course, if we've seen an incredible decrease in cost of fertilizer, food may come down at least to stabilizing when it comes to inflation. What about China to US freight rates? Well, we've already seen them front loading here. Massive declines. We're almost all the way back to where we were before the pandemic. So a pretty good level to be at. And of course, this bodes well for goods inflation. And then one of the other ones before we talk about energy has to be used car sales. If you load up any of the used car sale websites, you'll notice things aren't necessarily all over retail anymore. Of course, some things are, but basically we're moving from being ridiculous on used cars and having huge increases to being deflationary here. We also know that energy costs have come down quite substantially, so that's also most likely going to continue to stack in. If you've been following the channel for a while, you would know that we've seen US oil per barrel starting to decrease and been decreasing basically for the last 6-7 months. Let's move over here to one of the other things that I wanted to state, which is, of course, we've got a 2023 competition. It's completely free. All you need to do is fill in your name and email address, and you go into the prize draw, which will be held in about 6 days from now. And of course, you have the chance of winning one of our courses. There's 4 prizes in total. And if you get the top one, then of course, I'll be talking to you very soon. So why not click the links in the description down below and check out that. Let's talk about emerging markets. This is something that a lot of people have discussed. Of course, we expect inflation to decrease. We also know, though, that the Federal Reserve having to keep the rates at a very high level for a long time is going to hurt specifically many US stocks, specifically the growth stocks and, of course, consumer discretionary and everything like that. But as we're seeing problems in the US market, we're also seeing improvements through some of the world markets. And this is what a lot of big traders and investors have been talking about. Now, it's oftentimes that when we see these declines from 0 to 20%, we've had steep increases in new bull markets from the iShares MSCI Emerging Markets ETF. And that's literally what it's called here. This hasn't usually been very wrong. If we take a look at some of the stats here, these are the stats over periods. Now, when we get this reading 1 week, 2 weeks later, even a few months later, it can be a little bit bumpy. That's the nature of emerging markets. Traditionally, what happens is money floats in really quickly. Everyone talks about it, goes sideways for a while, but then it does usually start a bullish trend after these readings. If you have a look at all the readings around, you often get some pretty nice percentage returns over the next 6 months. And it's the markets that you're probably wishing to now have a look at. It's the first time really in over a decade that emerging markets have been worthwhile considering. And you can see here why I say over a decade. Take a look here all the way back from the global financial crisis, which is over here at 2008, and how it's been a sideways market. This is what they call the lost decade. Effectively, it's a period of time where the market has been so underperforming that it didn't really give you any return. Many markets have suffered lost decades. Luckily, the US hasn't for quite some time. But of course, before the global financial crisis, really the US did. It had that tech bust and didn't really perform very well. If you'd bought from the 2000s to 2008, it hadn't really done anything. So do remember, lost decades happen in all markets, and that's what many people are now seeing in the emerging markets here. Momentum rebounds are also quite positive. We don't usually get too many of these reads over the last 20 plus years. And specifically when we've had these kind of McClellan summation index rebounds, they've been fairly positive. Here are the stats around that. And you can see the reads here are very positive and big percentages as well. When we've had these, they've realistically not been wrong over 2 months, 3 months. The problem is the amount of data that we have. It's only a few times in history that we've ever seen this particular switch in trend. And the 3-month data, while looking really fantastic, again, it's just not enough data for us to absolutely say, yes, this is a great market. It's always proceed with caution, make sure you have risk management in place. But do emerging markets look better than some other markets around the world? Well, the data would say, yes, they do at this stage. So that brings us to the S&P 500 for 2023. While it may look like emerging markets are great, most of you out there really love the US, and for good reason. The Federal Reserve, literally the US economy being the biggest in the world, and of course, we have the best part, which is innovation and the US dollar. The US dollar being the major in the world, really powerful systems towards making the S&P 500 the best market in the world. So what do we expect for 2023? Well, we're hoping for some type of value to actually come back into this market. It's been sitting at 17 times forward earnings for a while. We're about to go into Q4 earnings, obviously, and we've got many very important earnings coming forward through realistically 2023. And as we know, if we start to get down to that 14 or 15 times forward earnings, you've got to pay serious attention to the US market again, something to keep in mind, and definitely to follow along with this channel because we will be talking about that number should it occur later on. What about anticipated earnings for this week though? Well, it's all about, as we know, banks. Banks come out on Friday, then we have Netflix on the 19th, and then of course Tesla kicking some of the bigger tech stocks off on the 25th. It's not really all about this month, but certainly banks will tell us a lot that we need to know about the current economic health and also whether the Federal Reserve has done enough to start to create demand destruction. We'll see that in the banks. And you can kind of already tell it's starting to happen as they're beginning to sack people. And unfortunately, we are expecting unemployment to rise, which is very common with recessions. Remember, here on the channel, we pretty much expect the US to come into a recession. The reason why is 50% yield inversion. Watch the previous video we just put out if you're interested to find out more about that and you're a first-time viewer. I always bring it up on this channel, super important thing. So what's happened in recent days with this market? Well, it's all been about some of the most hated sectors doing really well. Of course, materials is doing massive numbers, and that's because of the China reopening story. It's the same reason why fertilizers are also starting to improve right now. But we've seen clean energy, semiconductors, gold for stagflation plays, and some of the most hated sectors doing quite well. Semis seem to be in a good place, and even over the last 24 hours, they were pretty good in trading. You can see here 1.3% on the day, and a decent recovery for quite a few of the higher kind of gamma style stocks. Let's jump into the charts now and talk about the key levels. The VIX dropped to 20.58. Nothing much to note here. Obviously, heading down to 20, you would expect ahead of the inflation numbers. And I wouldn't be too surprised to see the VIX spike a little bit during the inflation day. We'll find out, but realistically, it's coming back to the 20 level. And as we know, 20 is where bulls and bears duke it out to figure out who's going to be the winner. If it's above 20, you're usually in a bearish style, fearful market. If it's below, then you're in a bullish style market. Let's have a look at yields. As we expect, pretty much nothing much happened here. April expectations of the bond market is 4.8% for the federal rate. Then we go to September, it's still 4.8, and December is where we get the cut of 4.54. US 2-year yields basically stayed similar in the last 24 hours, so not too much to note through that period. What about TLT and Treasury bonds? They dropped, so we saw a 1.66% decline in Treasuries. And I do think Treasuries down in these levels, around that $100 mark, is a very interesting level for Treasuries. A lot of people are discussing it, kind of unfortunately, about how Treasuries are going to be the outstanding investment of 2023. The reason I say unfortunately is if everyone sees something, that's not usually good. But then again, so many people in 2022 thought Treasuries would be great. And of course, that was not the case. Around these levels, if you put it back to historical reasonings, you can kind of see why people like it around this point. And it does tend to do well during deflationary busts, which is probably what we're in right now for the US economy. So certainly it's one we'll be watching. LQD did drop as well. So we saw LQD, corporates, and also high grade yield bonds both drop. This was a great indicator for 2022. We're still doing work to figure out whether it's going to be as good during 2023 as a lead indicator. I have a suspicion it won't be, but of course, we'll talk about that in subsequent weeks. Let's move over to the US dollar. What's occurring here? So the US dollar has been a little bit sluggish. I mean, it's probably expected to have a pretty poor year. Most people thought that the US dollar wouldn't be as strong last year, but it was. It's already dropped substantially. And if you're looking at this on the surface, looking at the weekly, you can't really like this market. Look at that big weekly rejection. It's a massive kind of rejection hammer. If we end up taking out those levels, then of course you would say, well, wait a second, we're probably reversing for the period. Depending on how this happens and what happens into inflation in the bank data on Friday, we'll probably know a lot more about the next week or 2 weeks worth of moves for the DXY. But at this time, if you're feeling bullish on US dollar, you're going to want it to break through 103.55. And for the bears, you're just looking for periods where it might sell off. Anywhere around this 103.25 to 50 area could be a potential sell zone. Expect it to kind of hover here ahead of the inflation data, and then we'll probably see a large move on this pair. Gold is something similar. We've had a lot of pickups around that 1870 area for gold, and you can see this is now in a heavy consolidation again ahead of CPI. And even breakouts, we're going to expect very, very large volatility on all these pairs and probably an increased spread size leading into all of these inflation numbers. So be careful here when it comes to gold. If I was looking at the small time frames, one thing I have favored a little bit in the last 24 hours has been around that 1870 to 1872 zone. I spoke about this in the private Discord that we do each day. It's a free 7-day trial as well if you jump over to fxevolution.com. And you'll notice that that area, it bounced off again in the last 24 hours. It does seem to be a little bit of accumulation zone. If we end up getting a breakout, it would make sense that this was accumulation into that breakout. Hasn't happened yet, but yeah, reactions off this 1870 are pretty important. Let's move over to oil. Oil didn't quite hit the 77 we hoped for. Obviously, we saw a sell at this time of recording. It's basically creating a bit of a trend line, probably waiting for the inflation numbers, and then it will make its move. Daily doesn't look really very strong for it. As you can see, we've got rejection, rejection, doji. So a long leg doji, what does that mean? Basically indecision ahead of the news. We've got a high at 76. If it breaks through 77, you're probably looking towards oil back up to that 81, 82 a barrel. I'd like to see oil drop back into 65 and 66, but that's going to really take further information and news. If you have a look at the weekly, it still looks pretty bad. It does a lot depend on how this week closes, whether we're going to the 65, 66 a barrel. And that's been a long-term call that we've spoken here a lot about on this channel. I've been very bearish on oil ever since realistically around 120, 110 a barrel. It's just made the most amount of sense. Now, that's different to the stock, as you guys would know if you've been following stocks. But yeah, the barrel cost, it makes sense to eventually hit that 65, 66, and then ideally accumulate around this area. And then hopefully we'll find some nice stabilized ranges there. Let's move over to Tesla. Expectations are changing here for the volatility. You can see 68% of the time by Friday, it's expected to be between 127 and 112, pretty wide numbers. And this is because the inflation number is pushing out some of these numbers here. 7% potential vol here on Tesla over the next 2 trading sessions. That's a pretty big amount of volatility. If we scroll down to the 2-hour, you'll notice that we've now put in what could be considered a little bit of consolidation. If we suddenly gap open down below, let's say on the Thursday data from CPI, it could be a bit of a sell day. So remember, the idea is that if we see something like this and then it gaps lower on the open, it probably will continue to gap through. The key is that it has to gap lower though. I don't know if that will happen on the Wednesday. I doubt it. But most likely what will happen is if the inflation numbers poor, it will gap lower and that will push through further selling pressure on something like Tesla. At the moment, it's in what could be considered an accumulation. We haven't broken through that 127 high yet. We do know that there's way too many 100 puts in this market though. So yeah, it's going to be one that's worthwhile looking at. We'll continue to follow Tesla very closely over the next session, and we'll go through the options in the next video ahead of the inflation numbers. So make sure to check that out. Apple, again, expectations are fairly volatile, but if you took both of these days together, what do you end up getting? A high, a low, and an open and a close pretty similar to each other. Effectively, a giant long leg doji. The markets are clearly playing kangaroo with us ahead of the inflation number. And it's clear here on Apple. I don't think there's a very big direction that we know of just yet. All we can see is that it came down, it found buyers. We'll use the S&P 500 to give us a bit more information about that. NVIDIA is similar to a few others. What we're seeing is potential consolidation after an amazing move up. If anyone got that, congratulations, especially after NFP. It was a great trade. And I'd like to see it consolidate. And again, if it then gaps lower, well, we know what's probably going to happen for that session, probably further selling pressure. And of course, these are educated guesses based on what we're seeing in the technicals. Amazon continuing to put into good numbers. Again, if it drops, sits around here and then gaps lower, again, could be further selling pressure. That's the sell side coming through, of course, for the inflation numbers. Let's move over to XLY, XLP. Another strong day, as we mentioned, for realistically risk-on stocks. almost all the risk on stocks have been doing much better in the last 5 to 7 trading days than the staples. And we're seeing that again here with XLY versus XLP. Strong outperformance. This is the first time we've had this in quite a while. So clearly a little bit of rotation occurring there in Wall Street and the bigger trading algorithms. If we move over to the DAX, it's ahead of big inflation numbers. You can see it's at that resistance underneath 15,000. Really no opinion on this at this stage other than it's at a super critical level ahead of the inflation numbers. You can see it made a new high. It's still at a critical zone though, so we'll see how that plays. But Europe has been much stronger than the US in recent weeks, and that's along with that emerging market kind of concept as well. We've seen China, Europe, Australia, and then obviously America really being the weakest market at the start of this year in 2023. Big number came out of the Russell 2000, again in line with picking up what you would call like riskier stocks. We're seeing quite a large move here in the US 2000, and it broke and closed above that rejection wick from the Monday session. Is that a sign that we've got a little bit more bullishness to come for the US stock markets? Well, that brings us over to the US 100 and the S&P 500. And we still like what we saw on the weekly, which was, of course, the rejection wick, That's pretty strong. Now, we don't know where this week will close, so we'll find out in only a couple of trading days. But we've still got an alert set just in case it does go above 11,300. And, if it does get above this after the inflation and close, it's going to be hard pressed to be a bear in the market over the next coming weeks, because that kind of looks like it's based off, it's found buyers on a demand level, and then all of a sudden it'd be moving forward. So we will have to be flexible here in our opinions, even if you're feeling bearish over the next coming months into the earnings and everything like that. It really depends a lot on this week's closure on how you end up feeling. SPY, again, expected weekly options, quite volatile coming into this Friday expiration. And the expected moves here are fairly large. We've got about 2-3% to each side, and 398 just so happens to be another key level that we've talked about. So let's move over to the SPX and show those gap fills. We've got a gap at 3995, and we also know that we have a gap in terms of closures and opens at 3750. So both of these levels, at some point, you'd have to expect the market to come back to them. I'm really still liking the idea that we get a spike into 4,000. I think a lot of people will have tried to short the previous session based on this shooting star candle. And why not? I mean, what happened was we got follow through. It looked like it had been a false break of what people were assuming is accumulation. And then we made this big wick. Now, if it does, because we've seen the Russell 2000 already break out, it kind of strengthens that bullish case, even though it goes against many, many fibers of our being, I'm sure. And let's have a look at the US 500 futures to talk about this level. So in the previous video, we speculated on the idea that 39.20, 39.30 would be a critical zone. We find ourselves here. We actually saw the market false break before the open, then Jerome Powell's speech, or whatever real reason it came up, it pulled back and gave a very nice entry during the session towards the bull side. This was actually a pretty good take profit for that. We find ourselves on kind of a 61.8 fib of this high to low move. And this is what they call the golden pocket. So basically, it's a critical zone heading into the next market move. You'll notice I've got 3 kind of big alerts here. I've got an alert for a new high pushing past this. I've got an alert for a low underneath 39.02 because I think that will probably spell further selling. And then I've got a little alert here just in between this box area. Basically, I'm looking for a real move towards the bear side to be signaled on the smaller timeframes. This is where you've got to be nimble and fast. Heading into inflation, it's going to be a volatile event that will most likely spike markets, and that often takes futures traders stop losses. So there's a couple of scenarios here I want to play out. The first one is that, of course, the market over the next, kind of 24 hours moves like this, breaches low, maybe pulls back, and then moves down further. That's a scenario that's very possible. It is at a bear short zone if the bears can get control of it. This is kind of where those bears need to press it. Now, if we end up moving up, and especially if we spike this high, what's the next level? Well, we've got a lot of stacks on 39.95, 4,000 level. We have unfilled gap up here. We have the downward trend line up here. We have a daily level up here. We have a Fibonacci up here that's pretty significant. And we also know that there's still a decent amount of puts in the system that are being placed over the last couple of sessions. Let's have a look at the puts. Let's refresh that for this week. So we'll go to the 13th here and refresh the whole thing. And as we go through the 13th, you'll notice that we still have a decent amount of puts sitting around that 380. And the calls are starting to come through, but they're really sitting around that 395, 400. So again, that's probably where you've got that ceiling. Max pain has slightly risen over the last 24 hours. And as we lead through to the 20th, it's going to be difficult for the market to go down too much. And that's just because there's so many puts in there. So over the next week, it would be best for the market to actually be kangarooing. The real question is, can it spike certain levels? So what happens if the news comes out and goes bang straight in here? Then you see a rejection off that level. Well, we probably know what's happening there. We probably know that the market's taken the fill gap, it's taken some liquidity, pushed people into buys, and then it's rejecting this. It's clearly a pretty big zone. If the market ends up going back down to like a 37.50, 37 kind of, or 3,800 zone, we know there's probably buyers there. So we know our two critical levels. We also know we're at a bear market potential, well, not bear market, but a bear potential zone. And we do know that if we get a new high, there's a very good chance that we spike into that 39.95. So yeah, we're at critical zone for the bears. If the bulls are going to remain control, they've got to get it through that 39.50. That should force, hopefully, the 4,000. These are all, of course, thought up concepts based on the technical levels that we know are stacked. And they're the three main levels that I'd be looking for. So at this stage, that's what we head into. Of course, we'll be coming for a very special show ahead of the inflation number, which will come out Wednesday after the close. So make sure to subscribe for that because that's going to be a big one. Let's move on to Bitcoin and actually hit our first target, which is 17.5. So I guess that's nice to see that the breakout did work. That 17,000 plus breakout was pretty nice. And again, it's at a critical zone ahead of the inflation numbers. We move over to Ethereum. Ethereum still hasn't broken past that 13.59 area. So we're looking for that to be a breakout zone. If that does happen, then Ethereum could move quite easily up to like a 1,500 or something per coin. Let's move over to the big news coming out later on this week. I will just refresh this so we can all see it together because there have been a couple of interesting numbers coming out. And let's just quickly go forward here to the Australian numbers. And what you'll notice is that the Australian CPI actually came in a little bit hotter. So contrary to what we've seen on the charts, maybe this number is a little bit more surprising and then the next number drops off. Look at that, 7.3% for the Australian CPI. Then we go to the US CPI, which is of course Thursday, and we've got that at 8:30 a.m. New York time, and that's going to be a big one. Core CPI is what you're looking for. You're seeing where the inflation is as well. Is it in food? Is it in rentals? We probably expect things like used cars to drop and energy to drop and those types of things. Then we got prelim UOM consumer sentiment on Friday, and do remember the big banks then come out with their reports. Make sure to subscribe to FX Evolution, hit the smash that like button if you enjoyed today's content, and we'll see you in the next video. And do remember, we've got that giveaway as well. So links in the description down below. Check it out. Bye for now, guys.